In this video, I'm going to go over stocks and put them head to head against gold and point out to you which is the better investment of the two to not only preserve your wealth but also to generate wealth. And if you want the short answer, I'll go ahead and say it before we start bumping the two up against each other. But in short, when the economy is stable and growing and is able to develop wealth, then stocks are the preferred investment. And the reason why is because stocks are more liquid, so it is easier to convert to cash than to gold, which require you to pay premiums and sell at discounts when trading the monetary metal versus the relative ask-bid spread on stocks usually. And the second thing is that stocks can also generate income through dividends. Gold, on the other hand, is a hard physical asset. It does not generate income through you traditionally unless if you try to invest in gold indirectly through stocks or ETF funds or mining stocks. But I'm talking about actually owning the hard asset. Well, then what advantage does gold have? Well, gold has one primary advantage over stocks, and it functions as the anti-investment. It's the insurance that you have in case if stocks do not work out for you, in case if the stock market crumbles, and usually that happens during times of severe economic stress. So when the economy is breaking down, when it becomes unstable and it ceases to function properly to create returns on investment, gold tends to be that anti-investment that not only preserves your wealth but actually generates your wealth during these times. So if you want to recap on there, the answer is it depends. During certain time periods, gold obviously was the better investment of the two. But during other times, stocks was the better investment of the two. But what were to happen if we were to just compare gold and stocks against each other over time and see which is the better investment? So for this, I'm going to take the U.S. stock market and the U.S. stocks represented by the Wilshire 5000 and compare that to the gold price ever since gold came off the gold standard, since the United States came off the gold standard in the early 1970s. And we will go through decade by decade and highlight the main economic and geopolitical events that kind of had their effects on stocks and gold during that time. So in round one, we're going to go over the 1970s, the beginning, okay? So in the first round, this era was characterized by high inflation, high interest rates, and instability in the economy due to high commodity prices. To give you the basic rundown here, you can see that stocks pretty much traded flat over the course of 10 years. They did have a sort of a little bit of a run up in the late 1970s. But if you look at gold, which is in this yellow line right here, and its index is on the right versus stocks, which are in green, and their index is on the left, gold went through a huge bull market during the 1970s. And the results speak for themselves. In round one, in the 1970s, the CPI inflation rate was averaged annually at 7.4%. Your producer price inflation on commodities averaged at 8.7% to bring the average inflation rate at 8%. And logically speaking, that combined with some instability in the Middle East concerning oil made gold go through a huge bull market. Gold would increase its price by over 20 times in 10 years. So it would yield an average return of about 36% per year, which is unprecedented. It's incredible, the gold bull market of the 1970s. Meanwhile, the stock market represented by the Wilshire 5000 yielded a paltry 3.6% annual return on your investment during that same time period. It could not even keep up with the inflation rate. And so in terms of real returns, the Wilshire, if you had invested your money in the stock market during this time, you would have lost money. But if you had invested your money into gold, you would have made a killing. So it's very clear that high inflation rates are very bullish for gold and bearish for stocks. We can say that if the average inflation rate were, say, 5% or higher, that tends to be bullish for gold. And if it's under 5%, it's probably bearish for gold and bullish for stocks. There's another ratio that I want to point out, and this is something that I might cover in a future vid, but there's something called the stock market to GPP ratio that I've created. This is similar to the Buffett indicator that I used in a few vids ago to compare stocks to interest rates. But in this case, I'm using a more conservative ratio. I'm actually comparing stock market capitalization to the actual private sector gross domestic product. So I'm stripping out government spending. And what I noticed is that whenever the ratio is over 1, that tends to be bearish for stocks, bullish for gold. And if it's under 1, that tells you that the stock market is undervalued relative to the economy, and that tells you that it's bullish for stocks and bearish for gold. So in the beginning, in the early 1970s, your stock to GPP ratio was 1.15. So both of these factors pointed to a very strong gold market bull run. But I would say the real winner was that high inflation rate. That high inflation rate yielded incredible returns for the gold market to the 1970s. So it's a knockout win in round 1 for gold. Round 2 covers the 1980s, and the situation would reverse. While gold would go through an unprecedented bull market in the 1970s, it would then turn to go into an unprecedented bear market in the 1980s. So the bear market was plagued with of the 1980s was plagued with high interest rates in the beginning that fell over time, along with high inflation rates that also fell over time, as well as a growing government deficit and extended debt. So the gold price over this time started off at peaking in 1980 at $850 an ounce. Let me go back here. And it would drop all the way to around 400 by the end of the decade. In the meantime, the stock market would go through a huge bull market. It would start around 1,000 points on the index, and it would end up at over 3,000 by the end of the decade. So to recap here, round 2, the 1980s, was where we had a much tamer CPI inflation of 5.1%, a really low producer price inflation of 3.1%, and then take note the stock to GPP ratio. So the economy was basically in the beginning of the 1980s outgrowing the stock market, and that has to do with the bearishness on stocks in the early 1980s thanks to high inflation and high interest rates. So this turned out to be bearish for stocks in the long run through the 1980s because it told you that that stocks were undervalued compared to where they should have been. That, combined with a tamer inflation rate, made the Wilshire 5000 accumulate 10.4% in returns year over year. Meanwhile, if you had held gold during this time, you would have lost 7% on an annualized rate per year. So the winner here is clearly the Wilshire 5000. Round 3 of the 1990s would prove to be much the same as it did during the 2000s. Gold languished during this time, falling even further from where it was around 400 to around $270 an ounce, and in the meantime the stock market would continue on its tear and rise by some 3,000 some odd points up to nearly 14,000 during that decade. The clear winner for round 3 is the stock market, and this was characterized by extremely low inflation, even lower than what we had during the 1980s, particularly in the producer price index. And again, despite the fact that stocks went on a strong bull market during the 1980s, the stock to GPP ratio was still below 1, indicating that it was bullish for stocks and bearish for gold. While the 1980s and the 1990s would put stocks ahead against gold in terms of number of rounds won, gold would have its revenge during the 2000s. The 2000s was characterized by huge unstable times. First, there were two credit bubbles that burst. One in 2001, the second in 2008. The first one was in the dot-com sector, and the second one was in the housing sector that would plunge the economy into the worst recession since the Great Depression. The second thing is that the 2000s was plagued by wars in the Middle East that drove up commodity prices, particularly oil. All of this would prove to be bearish for stocks over the long run and bullish for gold. And in round 4, while the CPI and producer price index inflation rates were relatively tame, even though during the CPI we had a rising housing prices, and I factored in those rising housing prices into the CPI that it was when it was stripped out in the 1980s, and the producer price inflation was plagued by high oil prices. It turns out that the overpriced stock to GPP ratio, where stocks were completely overvalued compared to the economy, would prove to be bullish for gold, combined with the Middle East wars, the 9/11 terrorist attacks, and the credit bubble burst of both the dot-com and housing sectors of the economy. So gold would go on to annualize returns at a whopping 14.3% per year, mirroring what the stock market did in the previous decade. And in the meantime, the Wilshire 5000 would actually have negative returns year over year of 1.8%, mirroring gold's negative returns of the previous decade. So gold had its revenge in round 4. Round 5 would prove to be the tiebreaker. And in round 5, thanks to unprecedented monetary stimulus to try to help stave off the economy, both gold and stocks vied for control of who was going to dominate during the 2010s. Early on, gold would strike out and go through a huge bull market up until 2012. Then it would peak, and the price would fall over time and stabilize around $1,200 an ounce after peaking at about $1,800 an ounce around the late 2015, early 2016. And then up until the end of the decade, gold would creep back up and claw back the gains that it lost from earlier in the decade. In the meantime, stocks bottomed out in middle of 2009 and then went on another huge, gigantic bull market swing as the stock market would more than triple its returns in 10 years. So in round 5, the Wilshire 5000, the stock market, clearly outpaced gold, although gold, if you had held gold for that decade, you would have gained an annualized return of almost 4% per year, but it would be overshadowed by the Wilshire 5000's nearly 12% per year. This decade was plagued by extremely low price inflation, as well as still overvalued stocks to private sector economic growth, because of the high prices thanks to the dot-com and the housing bubbles of the previous time, along with monetary expansion. In the end, though, although an overvalued stock market would prove to be bullish for gold, it was those extremely low inflation rates, particularly in the producer price inflation, that would put stocks over the edge. And part of this was characterized by the shale oil boom of the early 2010s, when fracking allowed us to produce energy at cheaper and cheaper prices, which would bring down those producer price index commodity prices, which would then keep consumer price inflation tame. And that sort of put the nail in the coffin against gold. So, saying all of this, the question becomes, what's going to happen next? We're for round 6, and it's the 2020s. Well, round 6 and the 2020s is a very interesting era so far. So in the beginning of 2020, the entire world was struck with a pandemic from COVID-19 emanating from China. In response to this, governments initiated all over the world mass shutdowns of their economies, plunging their economies into a deep, deep recession, and then having their central banks paper over the losses with more and more money printing. This should be bullish for gold, and indeed, when we take into account the CPI inflation rate and the producer price inflation rates, it does look to be bullish for gold. For the average inflation rate of the two industries is over 5%. In the meantime, stocks are incredibly overvalued compared to the private sector economy. Another bullish sign for gold. Yet the stock market has outpaced gold during the last year and a half. While gold is still averaging an annualized return of a whopping 9.4% per year, stocks are on a huge tear, running up to some 22% per year. So the question becomes, what's going to happen during this decade? Will stocks defy the historical norm, or will they return to the historical norm? Will the stock market correct itself, languish out over the long run, and gold will continue through the bull market? In my opinion, I do believe that gold will continue its bull market run. I do believe that this jump up in stock prices is just for the short run. And just like the 2000s, when the stock market bounced back from the 2001 recession, it looked like initially during the mid-2000s that stocks would outpace gold again. But in the end, the stock market would fail due to a credit bubble burst. And this, combined with rising inflation rates, I think it's going to put gold on a strong, sustained bull market, while the unsustainable bull market of the stock market will languish out in the early 2020s in the coming decade. Having said all of this, even if we were to count the rounds, it would seem that, say that gold wins round 1 and the stock market wins round 2 and 3 of the 1980s and 1990s, with gold winning round 4 and the stock market winning round 5, even if gold were to win round 6, that would only put gold's rounds of winning against the stock market at 3-3. And that seems pretty fair, because you have to think about it. Gold only wins if the economy fails. And so it looks like during the decades, the economy tends to underperform gold, or really the stock market tends to underperform gold about half the time. But what about in totality? Well, if we were to invest in gold, and if we were to invest an equal amount of money in the stock market, you can see for yourself in this chart right here that gold completely wipes out the stock market in terms of growth, except for a very, very brief time during the mid to late 1990s. If you were to own gold for 50 years, you would have outpaced the stock market in terms of annual growth and total returns for nearly 90% of the time period. So for about 45 out of 50 years, you would beat the stock market just by owning the precious metal. And even though stocks have gone on an unprecedented tear right now, they have only been able to recapture the losses that they had against gold from all the way back in the 1970s. You can clearly see it, that the stock market was clawing back its losses, and only until now it has reached and met back up with that gold price, much like it did during the 1970s, much like it did during the early 2000s. And if you look at when these times when these two lines coincided with each other, during these times, gold would go on through a bull market while the stock market would languish behind. And in the case of the 2000s, it would actually drop from a credit bubble burst. Now, it is possible that the stock market could go through a dot-com-like boom. Say a new technology gets developed that innovates production and revolutionizes economic growth. Well, sure, you can see this along with the bear market in gold. But even then, I would wager to say that because of all the money that has been printed and cheap debt that the Fed has made available to the economy, it would be nothing more than a bubble. And just like it did during the 2000s, it would burst, which would then spawn the gold bull market. So the gold bull market is going to occur in one of two situations. It's either going to occur right now, or it's going to be delayed by some temporary advance in a stock market bubble that burst, and then gold goes through its bull market. Either way, I hope this puts things in context for you and allows you to make, hopefully, the right decision for yourself based upon what you trust. And essentially speaking, it's, do you believe that the economy is stable and will remain stable for the future? If so, your investment should be in stocks. But if you believe that stocks are overvalued, that rising inflation will destabilize the economy, and that reckless fiscal and monetary stimulus will derail the economic growth even further and exacerbate the problems that are going on, combined with the remnants of a pandemic that is still leaving our economy handicapped, then to me the answer is clear, and that is gold. For me, I am placing my money and my wealth in gold right now. The reason being is because I just don't think the economy is stable. Once the economy does stabilize, characterized by lower inflation rates, stronger economic growth, and a lower stock to gross private product ratio, along with a fully reopened economy, then and only then would I consider stocks to be the better investment versus gold. Thank you guys for watching my vid. If you like the content that you see, make sure that you hit the like button and subscribe to my channel for more of this. I'll give you more insights into precious metals and the stock market and the economy as time goes on. My next video, I think I'm going to cover my gold outlook for 2021. I think I want to go over that next to tell you what's going to happen, what I think is going to happen to the gold price in the future, and it will also contain my outlook for the stock market going to the end of 2021. So you definitely don't want to miss that. So until then, I'll see you next time.